what the price of a stock should be, and that was pretty nice. But the problem is that as time went on, you started seeing things like the internet, right? So as the internet comes along, Buffett doesn't know what to do with that. In fact, Buffett to this day has a huge bias against the tech companies, Silicon Valley companies. Why? Well, because Buffett doesn't understand how a website can be worth $100 billion. He's like, what is it? It's not a factory. It's not a, they don't have any trucks and buildings and assets that I can actually touch. Or if they do, they're not worth very much relative to the value of the company. Some of these companies don't even have cash flows. You're not even making any money yet. How do I value you when you're losing $5 billion a year like in Uber? So Buffett doesn't trust a lot of the tech IPOs. And I think that it makes sense to a point, in the sense that not so much that you should avoid them, but you should be very cautious with them, because things can always change. And the thing is that, the internet, I think, confused Buffett, but crypto just like made his head explode. Like the internet was confusing. He was just getting used to the internet. Crypto is where he looks at that and he says, that's a bunch of crap. Like even Donald Trump, who's been a heavy real estate investor for many years, he's flat out said, cryptocurrency isn't real money. It isn't real money, blah, 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 blah. Well, I mean, it kind of is, but is it fake money? Yeah, it's kind of that too. But the thing about it is, if you look at the essence of money and the essence of wealth and what it actually is, then what you realize is that all of it's kind of fake. Like all of it's not real to a point, right? So it becomes very tough to kind of measure what these companies should be worth. So the danger of many of the IPOs that you're seeing, going out on the market now is that, nobody knows how to value these companies. Like Uber, nobody really knows how to really assess a company that's losing as much money as Uber, right? They've actually said that Uber is the absolute worst investment in the world based on market fundamentals. Like, so when you look at Graham and Dodd Buffett style fundamentals, Uber does horribly. Like with their models, Uber wouldn't even be considered as a company that you could value and come up with a positive valuation. However, there is one trump card in all of this, not to use Trump deliberately, but this has nothing to do with Trump. This is just a trump card. Ultimately, an asset on the market right now today is valued based on what people are willing to pay for it, right? So some of these companies they remind me of Gucci belts, right? Gucci belts have no value to me. I would not pay more than $10 for a Gucci belt because I think it's stupid. It's just, it's corny. It's weird to me. But, maybe you could convince me to invest in Gucci belts if you convince me that there's a market for people that'll pay $500 for a Gucci belt, right? So now that the fact that people have decided that a Gucci belt is worth $500, that makes it real. That makes it's like, oh, well then, okay, great. We can buy them for $20, sell them for 500 and make the profit. Business rule number one, buy low, sell high. Great. Let's go make a fortune off Gucci belts, right? And so is that real or is that not real, right? Well, it's very real as long as it's all sustainable. Now, what is also happening in that dynamic, and I'm comparing a lot of these stocks to Gucci belts because that's what they are. They become very trendy and fashionable, and so everybody wants to invest. Like in Beyond Meat. Beyond Meat, oh my God, the Beyond Meat stock, which I'm a little bit of a hypocrite if I criticize too much because I actually own shares in Beyond Meat. But Beyond Meat is fascinating because here you have a company that has a price valuation where the experts have said that this company, in order for this price on the market to make sense, this company needs to be making $5 billion in the next decade. They have to make $5 billion a year in revenue in the next decade. So I'm sitting there thinking, oh, well, maybe they're just making $1 billion. Maybe they're making 1.2 billion, right? Let me tell you how much Beyond Meat is making right now. Let me Google this. Beyond Meat's revenue, their earnings for the second quarter of 2019, let me make sure I get the number right so I don't get it wrong. Come on, give me the number. Give me the actual number. I need the number. Their revenue right now for this past quarter was $67 million. $67 million. Now, if you want to do the math real quick, let me do the math for you. 67 million is a little bit more than 1% of 5 billion. So the fact that this company in order to justify the price that people are paying for it on the market, the fact that this company needs to be making $5 billion a year in 8, 9, or 10 years, that's like signing, a #1 draft pick like Zion Williamson. Zion Williamson is the #1 draft pick in the NBA draft, right? So let's say that Nike signs him and they pay him, $1 billion or something, right? Which I think the Jordan brand signed him. That's like somebody saying, well, that in order to justify what you just paid Zion, he's going to have to win 6 NBA championships in the next decade. That's pretty audacious. That's a pretty huge bet that you just made, that he has to be as good as Michael Jordan in order for that price to be justified, right? So that's kind of where Beyond Meat is. Beyond Meat and Uber and companies like that, Beyond Meat, Uber, and WeWork, those are 3 companies that come to mind. They have to become the Michael Jordan of tech companies in order for their price to be justified. They literally have to grow as much as Amazon has grown in order for the price to be justified. And every company ain't going to be Amazon, right? So a lot of people would say, I'm staying away from that. Like I bet you Buffett has stayed away from companies like that. But the thing about it is that at the end of the day, the price that people pay for it is not usually based on the fundamentals. It can be based on demand and supply. Just people saying, oh, I think Beyond Meat's a cool company, I want to own their shares. But I can guarantee you this, when the recession hits, which it will, there's going to be a recession. There's no question about it, because there's always a recession. It's like me predicting that one day you're going to catch a cold or one day it's going to rain. When the recession hits, Beyond Meat, Uber, and WeWork are going to pop. Their stocks are just going to plummet. I don't even know if WeWork's public yet. I got to double check that. I know they've raised a lot of money. I got to double check on whether they're public or not. I think that they're on their way to being public. All these companies that get all this funding, the goal is to eventually take them public. That's what the venture capitalists are trying to do, so they can get their money back. So ultimately, I would just say, if you want to participate in and invest in these companies that are, that are out there, that are, that are very popular, just be really thoughtful and cautious and make sure you diversify. If you diversify, you should be okay. If you don't diversify, then that's when you're taking a big chance. All right. So what is idiosyncratic versus systematic risk? First of all, let's talk about risk. What is risk? Risk is anything that can cause you to lose money. Anything that can cause your bank account to be a little bit smaller than it was yesterday. That's a risk. That's what they call a risk factor. That's something that can cause problems. So in your own life, you've always understood what risk factors are. Like, so for example, if you are dating somebody and you know that they have bipolar disorder, or you think that they might have a mental illness, then you're kind of thinking about this investment you're making in this person, this investment in love, and you're worried that their erratic behavior is a risk factor in your life. Like, yeah, sometimes she's really nice to me, but sometimes, man, she be tripping, and so I don't really know if I want to marry her because I'm not really sure what I'm going to get, right? So a risk factor is pretty much anything that can affect things going the way you would like for them to go, right? So risk, what does the presence of risk do? Well, the presence of risk drops the value of an asset. When an asset has more risk, everything else equal, if you have 2 assets with making the same amount of money, one is super risky, one doesn't have any risk at all. Well, the one that is super risky is going to see a lower market valuation than the one that has no risk at all, okay? So ultimately, the thing about risk, though, that's really fascinating is that there are many, many, many kinds of risk. There's what they call idiosyncratic risk, and there's what they call systematic risk. Idiosyncratic risk is risk that is specific to that one particular stock. It's the risk that one company is going to have financial problems that are going to cause it to not be able to perform the way you hope that it will perform. Maybe the CEO dies or quits. Maybe there's drama in the company. Like Uber, one of their idiosyncratic risk factors is that they had a cultural issue. There was a lot of sexism, a lot of frat boy kind of behavior. There was even some racism. A lot of people don't talk about it, but there's actually a black man there who I think he killed himself. He actually committed suicide. I think if I'm not mistaken, I believe he did work at Uber. And so that's a risk factor for them. For Tesla, Elon Musk was a risk factor, an idiosyncratic risk factor. They don't know what he's going to say. He might tweet anything that causes an SEC investigation, which can cause the company's stock price to plummet. But then there's other more fundamental risk factors to the company. Like, for example, if you are an oil company, then one of your risk factors could be how the oil market does and how it relates specifically to your company. Now, oil is a bad example, though, because that actually jumps into the other category of risk, which is what they call systematic risk. Systematic risk is risk that affects the entire system. ecosystem, risk that affects a lot of people, risk that affects a lot of companies at the same time, and doesn't specifically have anything to do with you in particular. So ultimately, one of the things that that you want to understand about systematic risk is that systematic risk is sort of this kind of thing that you can't avoid. It's really difficult to get away from systematic risk. So for example, an example of systematic risk would be if the whole US economy plummets. If they make an announcement that, oh, the economy is garbage, now we just found out that the whole economy is headed straight to hell. Well, your stock portfolio is going to get hit. It's going to be very difficult for you to hide from that kind of risk. Okay, so ultimately, systematic risk, it can't be avoided. It's just there. It happens as part of investing. There's nothing you can do about it. Idiosyncratic risk can be washed away. Idiosyncratic risk is not the kind of risk that you should have to take on. You shouldn't have to worry about whether or not like your whole portfolio should not die because one company went bad. If your whole portfolio dies because one business goes bad, then that means that you didn't invest in the right way. That means you put your money in a way where you didn't spread it out and not put all your eggs in one basket. So let me give an example of idiosyncratic versus systematic risk. Insurance companies. Insurance companies, they don't try to make all their money by insuring one person, right? What they do is they insure thousands of people, right? Why? Well, because if one person dies, another person lives. If one person gets sick, another person's healthy, right? So basically what they've done is they've washed away all the idiosyncrasies where they don't have to worry about what's happening with any one person. Then they've gone to a systematic sort of risk profile. So that means that if you are, let's say that you are a company that insures thousands of people, and the majority of the people you insure live, near Louisiana, and Hurricane Katrina comes through. Well, that's a big systematic event that's going to affect everybody who's invested in Louisiana. So you're probably going to lose money because something big happened. There's some big systematic event that has occurred that's causing you to lose money, or global warming, or maybe there's a bunch of earthquakes, or whatever it is, right? So those are big things that you can't control, almost like God risk. Okay, so ultimately, with investing, that's how you categorize risk. And risk is very important. When risk goes up, when everything else is the same and risk goes up, or then prices go down. So Donald Trump, for example, he tweeted something recently where he basically said, yeah, I've been negotiating with China, and the negotiations are going bad, and we probably won't end this trade war anytime soon. Well, at that point, stocks went boom, right? Stocks dropped because what happened then was that risk has gone up, that bad things are going to happen. Uncertainty has increased, so prices drop.